All right, welcome to Looking at the Markets with David Modell. Today we have a special guest. His name is Mr. Seth Golden, and he is a former Chief Market Strategist at Capital Ladders Advisory Group and has authored numerous articles for Talk Markets and Seeking Alpha, among others. He is also a must-follow, in my humble opinion, on StockTwits and Twitter, and has graciously offered to share his market expertise with us today. Thank you so much, Seth, for speaking with me today.
My pleasure, David. Thank you for having me.
Absolutely. I've been, reading your, especially your Seeking Alpha and Talk Markets articles pretty religiously, and I always enjoy them. So let's start out from the beginning. What is your background in stocks and finance in general?
Well, I started probably in 2000, 2001, just after the dot-com bubble. Oddly enough, it was my grandmother who experienced a sharp decline in her portfolio back then and didn't know what to do. So she opened it up to me, and all I kept seeing was, her account balances dwindling, and that's kind of what introduced me to stocks, portfolios, and what you need to do as an individual to pretty much secure your retirement.
Right.
And so that's how I got into it. I worked for I was a runner at Goldman Sachs way back in 2007, 2008, and the analyst covering by 2009, I was a junior research analyst, which is nothing more than a glorified coffee getter, if you will.
Right.
And the head research analyst for handsets and hardware, your mobile equipment providers. Research in Motion was the biggest going back then, and he was leaving. And he said to me, if you really want to make a name for yourself, start covering this company, and offer us, what your insights are. And it took me about 6 months, and I delivered a report that was very much in contrast to what Goldman was rating on Research in Motion back then. And I wound up leaving the firm. I had a sell rating on Research in Motion. They were losing way too much market share to Apple, who was introduced, growing in the market by 2010. And I just saw a very hard times coming for Research in Motion. And obviously we all know how that story ended.
Sure, absolutely. Okay, so wow, that's a pretty impressive background, and so let's come to modern times. Why don't you tell me about the projects that you're working on currently?
So after leaving Goldman Sachs, I started Capital Ladders Advisory Group with a couple of partners, and we built that business over a 5-year period to where it was acquired in October of 2015. We had a very strong client list. It was strictly institutional research. We did some retail investor work as well. But once that was acquired, I basically became a consultant. My specialty, my areas of expertise are in the retail and consumer goods space.
Right.
And so I was consulting. I've been consulting for the last several years for the various different retailers, whether it be Target, JCPenney, Walmart, Bed Bath & Beyond, as well as providing analytics for these companies as well, or I should say for investors who are invested in these companies. I've done analytics and research on a lot of the consumer goods, Keurig Green Mountain, who was acquired, Coca-Cola, Pepsi, SodaStream, and the like. Most recently, Fitbit. So that today I still do a lot of consulting work, and I really enjoy putting my analytics together and publishing them freely, like as you came across them on Seeking Alpha and Talk Markets.
Right, absolutely. And we'll touch upon the retail sector momentarily, if you don't mind. But
sure.
First, you're known for trading VIX products, such as UVXY, TVIX, and so on. What is your approach to trading these VIX ETFs?
Firstly, I should caveat this by saying they're not for everybody.
Okay.
VIX leveraged instruments, most of them are designed with a decay in the product, so they over time they will fall in price.
Right.
So you're essentially, your best positioning is from the short side. However, as we all know, positioning short comes with a host of different variables that you need to consider.
Yep.
I've been investing in these products since 2012, and I've learned a set of core principles to utilize when participating in these products long term. So, for instance, UVXY is the one that I started with in 2012.
Right.
And I've maintained the core position in that instrument since then, which has generated for myself, for friends, for clients, a great amount of wealth. I mean, if you simply go to the chart, you see it starts in the upper left-hand corner and does nothing but go down to the lower right-hand corner,
yeah,
per the design of the instrument.
Sure.
But essentially, in order to take advantage of that, you have to follow a set of guidelines or best practices, if you will. And I outline those in my various articles on Seeking Alpha and TalkMarkets.com.
Right, okay. And there might be an element of luck in there as well, because there has been a bull market. So, because imagine if you had adopted that strategy of shorting a VIX product, let's say in 2007, okay? It could have gone very wrong. So, how do you hedge? Do you use stop losses? How do you protect against that?
No. One of the best practices, so taking, for example, the 2007 financial crisis and using a VIX product. So a VIX product essentially is not bound to the market itself. It's bound to VIX, the volatility. So a market can actually go down, and yet the VIX will remain, may go up a little bit or remain flat. And a perfect example of that is actually the Brexit event.
Yeah.
Upon the first day of Brexit, you had a strong spike in the VIX, which elicited a strong spike in the UVXY product or the TVIX product, which are very similar. However, even though the markets went down on the Dow, another 250 points the next day, the VIX actually went down. And so did UVXY, so did TVIX, and like instruments.
Interesting.
So the theory that, in a 2007 type event, you can get blown out of the waters with these instruments if you're short, it doesn't really hold up as a one-to-one correlation.
Okay.
So hedging is not really optimal. What you want to do in order to protect yourself to some degree in these types of events is to make sure you have enough liquidity. So let's say you have a portfolio of $100,000 and you decide to short VIX products. You don't want to short $100,000, your total capital. You want to have a small position and make sure if that goes up, if it goes against you, let's say 100%, which is possible,
right?
You have enough liquidity there so that you don't achieve a margin call or get your shares called in.
Right. Okay. That makes sense. Okay.
I know that was a lot to take in, which is, it's easier when you read it on paper.
Yeah, no, but that actually makes sense. And so have enough liquidity and just having the iron stomach to ride it out, I would
Correct, because you will see in those types of event, your account, starting to, elicit those losses.
Right.
But optimally, if the shares are available to short in those types of VIX events, you want to add. You want to be adding positions in increasing value. This way, when it does return to its normal trend, which is to decay, these VIX products, their normal trend is to decay in price.
Yeah.
You have positioned yourself to take advantage of that.
Okay. Wow. Okay. Very good. That's You know, that's the total opposite approach of what I think most people would do intuitively, but it actually makes sense when you explained it. That's great. That's great.
Right, and that's one of the reasons why I write these articles, because I know there's a lot of misconception on how to participate with these products.
Yeah. Okay. Very good, sir. Now let's get back to retail trading. I've seen your articles on Fitbit and Target. I actually have a long position in Target. Self-disclosure time.
Okay.
But no, I bought very close to the bottom somehow. I attribute that to complete luck.
You and I both.
Yeah, okay. Exactly. Now, you've written on retail companies such as Target, Macys, JCPenney, and so on. Is there any reason to have optimism for the retail sector and these stocks in particular?
Well, I'm glad you positioned the question that way, because the retail operation and the stock should be looked at separately.
Okay.
The retail operation for any of the name retailers that you mentioned, I would say there's not a lot of reason to be optimistic. The trend from consumers is away from brick and mortar toward online or experiential shopping.
Right.
Experiential shopping. And none of these retailers are either offering that or have the ability to scale those types of operations quickly enough to offset what is happening in their brick and mortar stores. So everybody's building out their digital e-commerce sites. Everybody's adding new products to them,
Sure.
making the functionality more user-friendly. And that's what they should be doing. However, there's no incremental impact on the total sales results because they're losing so much at brick and mortar.
Okay.
So from that standpoint, there's not a lot of reason to be optimistic. From a stock-specific standpoint, what I would ask investors to consider is, okay, whose balance sheets look the best? Who has steady cash flow? Even in in the event of a greater downturn in their brick and mortar business, who has the better balance sheet? Who's giving you a yield, a dividend?
Yeah.
So if we're looking at Macys, we're looking at JCPenney, we're looking at Target, I would say Target would be the one to go with because they have a better infrastructure. They have a much larger store base. They have a huge buyback plan of over $5 billion now. And they give you a 3.6% yield.
Yes.
Now, you could argue the fact that Macys has a good yield, but don't know how long standing that is given their current restructuring efforts, their lack of free cash flow, and the trend in their sales has been down for, it's going to be 2 years now. And obviously, JCPenney's balance sheet is riddled with debt. They have no dividend to offer.
Yeah.
It's more suspect, if you will.
Interesting. I notice you've only spoken of fundamentals in the company. Nothing about charts here. I haven't heard about resistance, trend
Correct.
lines.
Yeah, no, that's very, very observant of you. The problem with you, in my opinion, I want to preface that. In my opinion, what I've experienced over the years is when these particular stocks go through this sharp depreciation in share price, the real term to understand here is that they're being revalued. Okay, they're being revalued based upon their fundamentals. And when a stock is being revalued based upon their fundamentals, the technical aspects, so the technical analysis, carries very little efficacy. And that has been true historically for most any industry you can imagine. So at this point in time, I rely less on the technicals and more on the fundamentals because I believe very much this sector and these in stocks in the sector are being revalued. You had JCPenney go from over $10 a share only 60 days ago to where it is under $70 a share. That's almost a 40% drop in stock price. You can't really argue the stock is not being revalued.
Right. Right.
So that's my take on it, and surely it's open to being wrong, but I've seen historically that this is not a time to really rely on TA.
Right. Okay. When a stock is being revalued, like these retail examples that we've covered, the trend lines and the RSI and the Bollinger Bands, it'll just blow right through those. And,
Correct.
Yeah, that's a great point. one more question, or maybe two, before we wrap it up. Why do you think so many traders fail at it, and is this fixable?
Can you be more specific? Fail at what aspect? At investing in general, or?
Yeah, the old
Okay.
the old cliche is that 90% of traders fail.
Right.
Yeah, can we fix this, or is this going to be just the way it is?
Yeah, it's definitely fixable. What I find more often than not, and this is, my experience from running an institutional level research firm, is that not enough retail investors or folks that are investing on their own or trading on their own are actually willing to support this aspect of going it alone with advanced research and analytics. In other words, there are reports out there that are easily accessible that give the average trader or the average investor opportunity to look at greater amounts of research, information, and data. And yet, they choose to just go by, what they can get freely in the public.
Right.
And sometimes that free information is value added, and sometimes it's not.
Yeah.
There are examples, widespread. But what I would say is the fix is increasing your resource level. Maybe paying for, if you're investing in IBM, and there's free free information out there, free articles out there, but maybe there's something of greater value that you have to pay 20, 40, 50 bucks for to get that report.
Sure.
That will actually help you to make a better decision.
Right.
With that investment. So there's definitely a fix, and it's about finding resources. You have to develop your resource base in order to become a better investor. Going it alone is never advisable. But if you are willing to go it alone by building resources, that's your best probability of success.
Sure, absolutely. Personally, I have found your free resources to be highly value added, for sure.
Thank you.
Absolutely.
Thank you.
So, yeah, I've been speaking with Seth Golden, and what I'd like to do is put any and all of your links and contact information in the description of the video. But why don't you tell us how people can contact you if they would like more information?
Sure. You're more than welcome. Direct email at seth.golden@coollinksit.com. Seth.golden, COOLINXIT.com.
I'll put that in the description for sure. Okay, and websites or other links?
No, we're not running a website at this moment. However, for all of my free published materials, you can go to seekingalpha.com or talkmarkets.com, which is where I publish. Talkmarkets.com is where I publish 90% of my articles at the moment.
Yep, one of my favorites. And if they want to find you on Twitter and StockTwits,
Seth, at SethCL.
At SethCL. Great. I've subscribed to your Twitter and StockTwits, and you're a frequent poster, and so people will not be disappointed.
Yeah, I try to be the average guy, just talking and sharing ideas and information to the degree that I have anything to say.
Well, you're very humble, but definitely above average in my estimation.
Thank you, kind.
Yeah, Seth Golden, excellent. Check out those links in the description. Contact him if you just you want to take part in his knowledge base, which is deep and wide as far as I can tell. Mr. Golden, thank you so much for joining me today.
Thank you kindly for having me. Everybody have a great day.
All right, appreciate it. Thanks a lot.